Alright, so you are welcome to FinAccount channel, and today I'm going to take you through company accounts. I think I've already taken you through the practical aspect of it, and tonight or this morning or evening, wherever you are watching me from, I'm going to do a short video on some theory aspect of company. So first of all, I've already explained what a company means, and in Ghana, when it comes to the jurisdiction of Ghana, the company operations are regulated by the Companies Act 2019, Act 992. For you to know that a company or a legal entity is registered as a company, there are certain characteristics or features that will let you know that there is a company, and one is separate legal entity. When we were learning accounting concepts and conventions, we came across this concept, separate legal entity. When you say a separate legal entity, that means that the company is distinct from its owners or the real people who established the company. And you see, it means that the company can own property and also enter into contract and also can be sued and be sued. So this means that for you to know a legal entity is a company, it must have this distinct feature, that is separate legal entity. And the most fundamental thing, or one of the essential things for you identifying a company as a separate legal entity, is that, you see, it is able to let you know what the company stands to gain and what the actual shareholders also stands to gain. Let's move on to the second characteristics that will also bring us to the fact that as a company or as a legal entity that is registered under Act 992, Act 2019, is that there's a limited liability. From our first semester lectures, we got to understand that when we say a liability, it's a present obligation for you to transfer economic benefit as a result of past events. So when we say a company or a legal entity is a company, it must have this limited liability, meaning that the shareholders or the real owners of this business must have a limited liability. That means that their financial obligation for the companies, this is limited to the amount of shares or the amount of money they've invested in the company shares. So when you say your liability is limited, how much you are owing wouldn't extend to your personal properties or your personal stuff, but it is limited to the investment you've made in the company or in the shares of that company. The third feature or characteristics is the perpetual succession. When you say something is in perpetuity, we are thinking about going concern. We are thinking that it goes to the extreme end and it is not going to end. So the perpetual succession means that even if there is an intention to curtail the activities of the company, it is not going to happen that way, because the company will continue to exist in the foreseeable future, even during the death of one of the shareholders. It will continue to exist. This is one of the main features that will let you know that this company or this legal entity is a company. The next thing that we can talk about is share capital. When you say capital in accounting, it means equity. When we were learning sole proprietorship, we saw that under the sole proprietorship form of business, it is one person who owns the business or regulates the affairs of the business. When it comes to company, a group of people come together to put their resources together, that is money. They buy the shares. And as we said earlier on, a share represents part ownership of a business. So for the companies, they don't have just normal capital, they have share capital. And with the share capital, we have preference share capital and we have ordinary share capital. So for you to know a legal entity is a company, you have to understand that their capital is in the form of shares that represent part ownership of the company. We can also talk about a common seal. You can never have a company that is having a different or unidentified seal. The signature, they have official signature on their document, their letterhead, everything is intact. Okay, so that will let you know that this company or this legal entity has been formalized to be a company. The next one is that you can even get to know their governance structure, how they are structured. They have board of directors. Aside shareholders, they have board of directors. The board of directors, we have chairman, we have board members. Within the board, it has section of unit or department that regulates or that monitors and evaluates the affairs of management. And one thing is that the owners or the shareholders who have also invested in the business, according to the Act 992, Act 2019, they've been given a stipulated rights and duties that will help them to also channel their grievances. Another thing is that as a sole proprietor, you don't have CSR, and in accounting we call it corporate social responsibility. You can't just pass by or move to the roadside a woman who is selling a provision, milk or tomatoes, and tell that woman that, oh, that woman is supposed to go and build a borehole or build build a school. No, you can't do that. But companies, as part of their regulatory frameworks, they have this duty as a corporate social responsibility to actually plow back or invest in the community in which they are getting their living. Okay, so corporate social responsibility is also another thing. You take example is MTN. MTN is a company that is limited, and sometimes they go to the villages and you see that they are investing or they are also doing or taking responsibility of building schools, boreholes, other things that the community might need. Let's take a look at the difference between the share capital that I just mentioned. Okay, so we have two main forms of shares. We have the ordinary shares and the preference shares. I've already spoken about this. When you talk about ordinary shares or people who possess the ordinary shares, we call them ordinary shareholders. They are the real owners of the business. They take decision. They have the right to vote. Certain assigned duties have been given to them for them to extinguish in their form or in the capacity of them performing their responsibilities. Okay, so ordinary shareholders, as I said, they are the last people to even receive their returns or dividends when the company is making profit, because they are the real owners. Ordinary shareholders have these characteristics that make them distinct from preference shareholders, because in terms of the company making a loss, they can sacrifice their returns or the dividends they are supposed to receive from the company. When it comes to preference shareholders, it's the vice versa of the ordinary shareholders. Preference shareholders are like hybrid, as I said in class. They are like hybrid investors. For them, they look like loan givers. It's as if they are giving the company a loan. It's as if they are actually being part of the real owners of the business. So we call them hybrid investors. For them, whether you make profit or loss, they don't care. What they care is that they are going to receive their annual returns. And all other things being equal, ceteris paribus, in case the company is not making profit, you have to make sure that you put or you record how much they were supposed to receive as their returns on their investments, and the year that you make profit, you can pay them all those accumulated debts of the interest. Okay, that is so. These are clear difference between ordinary shareholders and preference shareholders. With the preference shareholders, they don't vote, they don't take part in decisions, because they are not part of the real owners. Let's move on to types of companies. You see, when it comes to Act 2019, Act 992, this Act stipulates or brings out certain kinds of companies that you have to be aware. And one of them is a company limited by shares. With a company limited by shares, we can have a private company limited by shares, and we can also have a public company limited by shares. And usually, when you are passing by a company, whether Kantamantua, Dabraka, KGT, Central Market, you look in front of some of these big offices and you see LTD. The LTD means limited. When you see LTD, it means limited. Okay, so when you say a company is limited by shares, it means that the shareholders, their liability is limited to the amount of unpaid shares or the amount of money that they've not paid on their shares. This is what it means. So imagine under the process of issuance of shares, the company issue shares, you go, you apply, you subscribe, then they will allot the shares, they call for the shares payment, first call, second call, third call, and you haven't paid. Your liability is the amount of the unpaid shares in that company. So if you say limited liability, this one, if the company is going bankrupt, you can't go to the shareholders' personal properties. No, it is limited only to the number. So the shares that you haven't paid, the company can sell that shares to defray the debt, or the amount of money you've invested in the company is what the company can use to defray the debt when it is going bankrupt. And with a private company limited by shares, the highest number of shareholders that they can have is 50, excluding employees of the company. So if a group of people are coming together to buy shares to establish a company, with private company limited by shares, you can't go above 50. The only difference between a private company limited by shares and a public company limited by shares is that with a private company, the maximum is 50 shareholders or real owners. But with a public company, the maximum is infinity. A lot of people, and it is always open to the public. We have company limited by guarantee. This is usually used by NGOs, churches, and the likes. So here they don't have a started capital, like they don't have a share capital. What they do is that this group of people, like a church, they come together that in times whereby the company is bankrupt, is insolvent, we have decided to stake our interest in the form that we are going to contribute this amount of money in order to ensure that the company is doing well. So let's take, for example, Aspi Pharmaceuticals Industry Limited is having some issues whereby they are going bankrupt. Then the shareholders will come together and pledge their support that I'm going to take, if the debt is $1 million, I will take let's say $500,000. Another person will take $200,000. Another person will take $300,000 in order to defray the debt. That is company limited by guarantee. We have unlimited liability company. From the name, unlimited liability company. Unlimited, their liability is unlimited. That means that if you are part of this company, you are a shareholder, and the company is insolvent or bankrupt, your liability can be extended to your personal properties. So they can even come to your house and come and arrest your daughter, go and use your daughter to defray the debt. You can have a personal car, the car can be snatched, can be sold and use it to defray the debt. That is unlimited liability. Your liability is unlimited. That means that it can extend to your personal or family matters. We have external company. External company is any company that is incorporated or established outside Ghana. When it comes to taxation, we call something permanent establishment, P. But because you are not doing tax, I won't worry you with all these things. Okay, so external company is a company that is incorporated outside the or jurisdiction of the country in which the mother company or the parent company is. We have one person company, and this one, I think someone asked me in class, can we have one person who just that? Yes, it is there. It's a private company that only one person is a shareholder and also part of the directors. And a classical example was Kofi Amoaben. In the year 2008 coming, Kofi Amoaben was the sole shareholder of UT Bank and other financial services. It got to a certain point that he needed other financial muscle, so he decided to flow shares for other people to come and buy. Let me take my time to explain a par value of shares and no par value of shares. And in class, I said categorically that when in Ghana, we don't have par value of shares. When you say par value of shares, we are talking about a share certificate that is having the symbol of a fixed rate stipulated on that share. So you have the share like a paper, a certificate whereby it is having 10 cedis on it. That is a par value. So another name for par value is the nominal value, is the face value, is the fixed value. It's on the share. And I said in Ghana, our shares are not of par value, but our shares are no par value. When they say no par value is a type of share that is not having a face value or a fixed value or a nominal value that you can identify on the share certificate. That is the main difference between par value of shares and no par value of shares. Then I think one thing that I wanted you to also know is about the treasury shares. When you say treasury shares are shares that the company has redeemed, the company has bought back. It decided to float. The public actually subscribed, but when it got to the calling, whereby they were supposed to pay money for the shares. They couldn't pay. So what the company will do is to redeem the shares or buy back those shares. And when the company is buying those shares or repurchasing the shares, it is going to classify them to be what? Treasury shares. It goes into the treasury of the company. That is treasury shares. So this is just a simple video. I want you to just pay attention. If you don't understand anything, play over and get to know the details of everything. These are some of the things. In case you have a special need, special question, do not hesitate to come to my DM and send me a message. Thank you very much. I want you to have a wonderful day, a wonderful night. I wish you all the best.